In 2025, the world stands at a turning point. The numbers seem deceptively calm. An IMF forecast nudged slightly upward, setting global growth at 3.0%. At first glance, it might suggest resilience. But behind that modest figure lies a fragile reality, one built on temporary surges in imports before higher tariffs take effect, on looser financial conditions, and on governments spending more than they can sustain. Beneath the surface, the currents are far more turbulent. Tariffs remain high. Geopolitical rivalries intensify. Policy uncertainty hangs over markets like a low, heavy sky. And in every boardroom, every trading floor, every finance ministry, the same question echoes: how long can this hold? In the United States, inflation refuses to yield. Month after month, prices rise faster than the Federal Reserve would like. The central bank moves cautiously, reluctant to cut interest rates too soon, aware that one wrong move could reignite the very pressures they've been fighting for years. The consumer keeps spending, but cracks are appearing, household debt is climbing, and savings are shrinking. Across the Atlantic, Europe keeps its head above water, driven largely by its service sector. Tourism, financial services, and digital industries provide a buffer, but manufacturing, the historic backbone of economies like Germany's, has slowed. Orders for machinery, vehicles, and industrial goods are falling, hinting at deeper structural challenges. In Asia, China finds itself in a delicate balancing act. Domestic services and consumption grow steadily, but the once relentless manufacturing engine is losing steam. Export demand has weakened, weighed down by U.S. tariffs and a global shift towards supply chain diversification. Beijing counters with stimulus measures, infrastructure projects, and a pivot toward regional trade. At the same time, it deepens economic ties with Russia and other partners, seeking to reduce its dependency on U.S. markets. And then there is the trade war, the most visible fault line in the global economy. On August 12, 2025, the United States and China agreed to extend their tariff truce for another 90 days. For now, massive hikes tariffs pushing toward 145% on certain U.S. imports from China and 125% on Chinese exports to America are paused. Markets breathe a sigh of relief. Stock indices from Tokyo to Sydney rally. The Chinese yuan steadies, oil prices ease. But the truce is only a pause, not a peace. Behind closed doors, the same disputes remain: intellectual property rights, technology transfers, subsidies for state-owned enterprises, and restrictions on strategic goods. Both sides maneuver, not to end the conflict, but to position themselves for the next phase. North America faces its own cracks. The United States has imposed sweeping 25% tariffs on Canadian and Mexican goods, steel, aluminum, automobiles, and more. Both neighbors retaliate in kind. The USMCA trade agreement, once hailed as a modernized foundation for North American trade, now wobbles under the strain. For manufacturers, the shared supply chains that stretch from Ontario to Texas are increasingly tangled. For consumers, prices rise quietly but steadily. The ripple effects extend far beyond these borders. India has been hit with new 25% U.S. tariffs, forcing New Delhi to seek alternative markets and strengthen trade with Southeast Asia. Brazil, South Africa, and other emerging economies prepare for similar measures, each crafting survival strategies. Some focus on regional pacts, others on self-sufficiency in critical sectors. But all must navigate volatile commodity markets, as prices for oil, metals, and agricultural goods swing wildly in response to political headlines. Global supply chains, the invisible threads binding the modern economy, are being rewoven. In semiconductors, a cautious thaw is underway, with some U.S. export restrictions on AI and chip components eased. Yet, the broader trend is toward localization and resilience. Nations and corporations alike are investing in domestic production, even if it costs more, valuing security over efficiency. This shift, born of necessity, is redrawing the global trade map. Financial markets watch every move. In equities, technology and consumer stocks outperform, while industrial and export-heavy sectors lag. In commodities, oil remains sensitive to geopolitical shocks, and gold glimmers as a safe haven whenever tensions spike. Currency markets dance to the tune of central bank decisions, with the dollar holding strong, the euro steady, and emerging market currencies under constant pressure. Economists warn that while the service sector is carrying growth for now, the structural weaknesses in manufacturing, trade, and investment could drag the global economy lower in the months ahead. Tariffs don't just raise prices, they distort decisions, discourage investment, and undermine trust between nations. Once broken, those bonds are hard to rebuild. The 90-day truce between Washington and Beijing is not just a diplomatic breathing space. It's a countdown. Every day wasted brings the world closer to a renewed tariff spiral, one that could push fragile economies into recession. The question is whether leaders will use this time to compromise or to prepare for escalation. History offers both hope and warning. Trade conflicts have been resolved before, but only when both sides saw more to gain from peace than from continued battle. In the 1930s, protectionism deepened the Great Depression. In the late 20th century, careful negotiation helped avert similar crises. Which lesson will 2025 choose to follow? Around the globe, ordinary people feel the weight of these decisions. In quiet personal ways, the price of groceries ticks upward. A factory order is delayed. A job opening disappears. These are not abstract economic shifts, they are lived realities. As the clock winds down on this fragile pause, the world faces three possible futures. In the first, diplomacy prevails, tariffs are rolled back, and a new framework for fair trade emerges. In the second, talks fail, and the tariff war returns with greater force, pushing the global economy into contraction. And in the third, the most uncertain of all, the truce drags on, unresolved, a lingering shadow that stifles investment and breeds instability. For now, we live in the space between these. Future's a 90-day window, narrow but critical. It is here, in this brief moment, that the next chapter of the world economy will be written. The stakes could not be higher. And the clock is already ticking.